Okay. All right. Welcome to another edition of Trader User Group's webinar education series. Tonight's session, or this morning's session, depending on where you are, is going to be on Option Greeks Part 1. And we're going to spend about an hour and a half going through this. For some of you, it's going to be brand new stuff because I know I've got a couple of emails. Some of you wanted to make sure the basics are covered, but there are some out there that I can see already that are fairly experienced, but you know, it never hurts to go back through some of this stuff again. So tonight, part one, about an hour and a half, got a lot of stuff to cover. And then we're going to do a part two. We'll probably go into option synthetics with the Greeks, and then we'll probably cover that. And if we got time, we're going to start throwing on some strategies and how option Greeks work around those strategies. So I can see this going at least 3 sessions, but we'll probably add some more as we have some of our other educational series. We've done, we're in the middle of running Iron Condors. We'll have another Iron Condor series coming up here probably within the next week or so. We're going to have one on diagonals. We've already done 3 or 4 of those. We're going to have another one coming up. We've done vertical spreads, butterflies. And so we're probably going to just interject a couple of those in there along with these option Greeks. And then coming up, we've got more on futures, and then we've got calendar spreads, and then ratio spreads and back spreads. So we've got a lot of education coming up here. Of course, for all our members, it's free. For those of you that are non-members, it's this is a $50 all Greeks, part 1, 2, 3, however many I run. And just so we covered, it's only $50. If you've seen one and you want to go see others, then it's only $40 for the others. If you want to join as a member, then just reach out to me. My Skype ID is out here. We'll get you signed up, and then all these things are free, so it makes it a lot easier for you. And I think you'll find the way these go through it really help you out dramatically as far as learning about options. Okay, so enough of the pitch there. Why don't we jump into this tonight? Just a little bit of admin. As I said, it's going to be an hour and a half session. Session will be recorded, and I'm going to post it within about 48 hours, although our support team is really good. They usually get it out there fairly quickly, but we say it within 48 hours. You will, for our members, it'll be in our private forum. That's where it's posted for all you new folks out there. You'll probably get an email with a direct link and an access so that you can go view it there. And just, you know, we don't take it down, so you can just go look at it. And then when we do part 2 and part 3, it'll just add to that. And for those of you that have already seen other educational webinars, well, then this webinar will just add to it. So once you sign in, you know, you just continue to stack the educational webinars that you've attended before. Okay, so that's a little bit about how we're going to do that and how we're going to run this tonight. So having said all that, why don't we just jump into this, and we'll kick everything off right away. We'll just jump in because I got a lot of slides to cover, a lot of things to talk about tonight, just to get these basics out of the way so that we can jump into synthetics and some of the really fun stuff in part 2, but I got to get the basics out. All right, so option Greeks. Before we jump in, let's talk about trading securities. Can involve high risk and loss of any potential funds invested. Any information, investment information that's provided here in our user group may not be appropriate for all investors. It's provided without respect to individual investor financial sophistication, situation, time horizon, or risk tolerance. Therefore, any of the information and techniques that we talk about tonight or any particular trades that I may talk about that I have currently here will show some on my screen, or any others that I may talk about that I may like is for educational purpose only. It's not intended to be a recommendation to buy or sell any specific security, no matter what your rat brain may want you to do. All right, now that I got all that fun stuff out of the way, why don't we just jump in the particulars. Let's jump into options, option review. Just real quick before we jump into this. It's pretty basic stuff, but I know we got a couple of basic folks out there, so I want to make sure that you understand it. Long calls, basically, are the right to buy. Expectation is bullish. It's a debit trade, so when you hear me say it's a debit trade, you got to pay to play. It's going to cost you money to put that trade on. Just a long call. Long put is also a debit trade. You got to pay to play. You've got a right, however, to sell. Okay, so remember, with a call, it's a right to buy. Put, it's a right to sell. Expectation, of course, is bearish. Now, if we come over here and we go the opposite of a long call, which is a short call, now you've got an obligation. It's an obligation to sell. Think of a covered call position, essentially. All right, expectation is bearish. You expect the stock to move away from your short position, and it's a credit trade. We call that you get paid to play. And then, of course, you got the short put. Again, it's an obligation, but now it's the opposite of a long put. Here you got an obligation to buy. Expectation is bullish. It's a credit trade. You get paid to play. So just a couple of really quick notes here on this. You can see real quick on all the short positions here, you basically have obligations, all right, which means you've got no choice. You've got to do what you got to do. You've got an obligation. You remember, you're the seller. You're selling something. So you've got to honor whoever's buying what you're selling, okay? If you are just the opposite, if you're long something, you're the buyer, then you've got rights. You don't necessarily have to exercise those rights, but you do have rights. So that pretty much nets out at a very high level all the various combinations of calls and puts, long call, long put, short put. Now, from this forms the basis of just about everything that you can do. We haven't included equities or futures, of course, right now, but this forms just about all the fun things that you can do with a lot of different option strategies depending on how you marry calls and puts, both long and short, and then strike price, and then the expiration period. When we throw in stock or we throw in futures, and depending on how we set these up, we can create synthetic positions, which we will talk about in part 2. It gets really exciting. But for part 1, just understand these are the basics. So why don't we go in and let's take a look at option pricing theory. And again, it's theory, and just pretty much how option price is derived. It's based on a mathematical formula. Now, I've got here a Black-Scholes model. You guys probably know when you're playing around with TOS and some of these other platforms like OptionView and others, there's a number of different mathematical models you can use. Some a little bit more accurate than others, but at the end of the day, it boils down to just a few cents. And I promise you, you probably would not even notice the difference. So I'm just sticking with Black-Scholes for right now because that's the main one. That's the first one that came out. Now, option basically is based on 2 components, pretty much basic, which goes into at a high level, the price of an option. You got intrinsic value and extrinsic value. All right, so those are the basic components of an option. And if you look at this, let me just do this here. If you look at how this thing it works itself, whoops. If you look at how this thing, let me just see here. Let's come back here from current slide. If you look at how this thing works itself out, that's what I get when I move my fingers on the keyboard really quickly, guys. You can see right here we've got an example here of stock that's at $50 a share. You got a call with a strike price of 45. So if you got a strike price of 45, we'll call it 40. K is another abbreviation for strike, okay? So 45 strike, and it's due to expire in 3 months. And it costs $8.50. Well, some of that $8.50 could be intrinsic. Some of it could be extrinsic. You've got to look at the location of the strike price to determine that. Okay, in this case, it's a call, and we're saying it's a long call. So we'll keep it simple. With a long call, if a cost is $8.50 with a strike of 45, if the current price is 50, right here, then we know, well, let's put it over here. Well, you know that you're going to be in the money by 5 strikes or 5 points. So you know that 5 is intrinsic value right there, meaning intrinsic value means if that option were to expire today, how much money would you have in your pocket? $5. All right. The other key component here is the extrinsic value, and this is important when you get into Greeks. Extrinsic value here is $3.50. So we know that the price of that option is $8.50, but we know the intrinsic value is $5. So that leaves the remaining balance here, or $3.50, basically all extrinsic value. So that means that is subject to a whole number of different things that affect option price. 1, time decay. 2, volatility. 3, interest rates, and I'm not assuming dividends right now. Okay, so we know that this $3.50 in let's say a theoretical, hermetically sealed world, if that price stayed at $50 a share, all right, and it did not move for the next 3 months, and it stayed right there. At the end of 3 months, this $3.50 would be worth zero. And then all you would have left is the intrinsic value of $5. So we know that from now until this expires in 90 days, I'm going to have some decay of the $350. Okay, that $350 will go away. Now, depending on whether you are long or you are short, it can be either helpful to you or it can hurt your position. All right, we'll go into that with various option strategies in part 2 when we get into synthetics, but I want you to understand the basics right now. Okay, so this $3.50 is subject to all of the option Greeks. Intrinsic value, assuming that stock does not move, intrinsic value is not subject to theta decay. It's not subject to volatility. Okay, it is just at a very, very minor amount subject to interest rates, but essentially the intrinsic value is what it is. If it were to expire today, all things being equal, that's how much money you'd put in your pocket. And you'll see the value of understanding intrinsic value when you start to put your strategies on. Okay, whether you're long or short, you're doing spreads, multi-leg, multi-month. Intrinsic value is really important in understanding what you've got there. So to net this out, the two key components that you've got to come away with is every option has both intrinsic and extrinsic value. If you're all out of the money, well then guess what? Your intrinsic value is zero, and then all of the option premium is strictly extrinsic value. But you have these two components with every option contract that you're dealing with that you need to know right off the top of your head. Now, we'll talk about in part 2 how you can adjust strike prices, take a look at volatility, and start playing with these so that you can make time decay, volatility, interest rates. You really don't need to worry about unless you start playing with leaps. So really what we're going to focus on is the time decay and the volatility segment, which is really going to affect the price of an option. And this really, understanding this is just so crucial in being able to really effectively employ various option strategies. Okay, so intrinsic value, extrinsic value. Now, the Greeks, let's get into the Greeks. Remember I told you that Greeks basically just help calculate an option price. So every option has a price. It's got a quoted, a bid, and an ask price when you go to any platform. And it really measures an individual option's sensitivity to the changes in those variables. And what variables did we talk about? Well, it's very simple. These are the variables that we talked about, the underlying price of the stock. Now, do we know that when we put on the trade? Yes, we know what the underlying value of the stock is. Strike price, do we know that? Yes, we do. How about timed expiration? Yes, we know that before we put on the trade because we select it. How about volatility? Do we know that? Well, it's one of the little, what I call the great white shark, because volatility changes, and it's usually, no, not usually, it is the last item that's input into an option pricing model to derive the current price of an option contract. Dividends, do we know? Yes, we know dividends. Now, there can be surprise dividends, but most companies, they announce their dividends. So when you buy a stock, dividends or lack thereof are already factored in. Interest rates, do we know them? Yes, we do. Now, the interesting thing is the only constant in all of these 6 elements that go into making up the price of an option is what? It's this one right here. That never changes. The option strike price is the only constant. So whether you choose an option that's going to expire tomorrow, next week, next month, next year, 2 years from now, the strike price is the strike price is the strike price. Doesn't change. Obviously, we know all of these other elements will and do change, some faster than others. These changes affect the movement and the price of an option contract. And depending on what strike price you selected, those changes can be either significant or they can be minor, which is why strike selection is really important depending on your risk parameters and current volatility and where everything is starting to shape up. It's kind of like saying, well, it's 32 degrees outside, the sun is out, it's kind of a warm day, low humidity, so it's fairly warm. So I'm going to wear a light jacket. Or it's 32 degrees outside, but it's a light drizzle, it's cold as heck, and it's just very, very high humidity, so it's got kind of a biting cold. Well, I may throw in a parka, I may throw in gloves and a few other things. So the strike price is a real key component. Even though it never changes, you set that strike price right at the beginning, and then you work these other angles. So proper strike price selection is very important. Now, all of these go into what we call the Greeks, and it's used. The Greeks are used. I'm a former military pilot, so these Greeks, I look at them. In fact, if you looked at the invite you had, it looked like a gears, right? And you got all these gears kind of connecting together like this, and some of the gears are small, and then some of the gears are big like that. So if this thing turns that way, then this thing turns this way. And if this thing turns this way, then this thing right here, depending on which side they're touching, if that goes that way, and this goes this way, all that kind of fun stuff there. The Greeks are the same way. The Greeks react. Some react opposite to others. Some react in the same direction to others. The speed with which they react is also related to the strike price. As you get really good at Greek selection and managing your positions by looking at Greeks, then you get really good at strike selection, and you will find that over time you are able to manage your option positions a little bit easier, and you can understand how to stress test them without a lot of issues. Now, right now our members are going through one of the things that I started with our group is what I call TUG trades, which is Trader User Group Trades. Every trade that I do, I put on in our chat room, and then I send an email out to all our members. So far through, through February, we're up year to date about 65%. And what I do, one of the trades that we're running, this is, I think, our second iron condor, and the members, you guys out there that are members, are learning just how to read the Greeks. And sometimes a lot of times you don't even need to look at the price of the stock, or whatever security you're trading. You can just look at the Greeks, and you know exactly what's going on. You can look at the volatility, you can look at the Greeks, and then you learn how to stress test it. What happens if the market moves by 15 points tomorrow down? What does that do to my position? Should I adjust it now? If I am close to this thing really blowing up on me, maybe I should adjust it now. I mean, these are the kinds of decision points that you need to walk through in your head. I've got here, I do this with every educational session that I put on. I got a trade checklist at the end that I'll share with you, and if you don't have it, then you can email me, or you got my Skype ID there. Just invite me to your Skype contact list, and I'll send it to you, one or the other. But these are the things that go into making up the option Greeks. Now, let's start off with the first Greek here, Delta, and we'll break down each Greek. We'll go through the major ones, and I'll just break them down for you, and we'll just so that you can understand them. Delta can be defined 4 different ways. All right, a lot of people they don't really think about it that way, but it can be. The first way is the rate of change of an option value relative to a change in the underlying. That's probably the most common way that most people look at Delta. They just say, okay, well, I got a 50 Delta, so if the stock moves up $1, I'm going to make 50 cents on my option contract, or vice versa. The second definition is a derivative of the graph of an option value in relation to the stock price. Now, you're probably going, what? Don't worry about that. All that really is talking about is that delta is not a finite number. It changes constantly depending on the movement of the underlying. And depending on where that underlying is located, the change in delta can be dramatic or it can be small, okay? And you'll see that in a minute. The equivalent of the underlying shares represented by an option position. I call it the hedge ratio. When we get into option synthetics, you'll see what I'm talking about there a little bit clearer. But I'll go through an example with you tonight. I'll go through a mathematical, just show you how it works. The estimate of the likelihood of an option expiring in the money. Well, that is another, generally, what I find most traders use, and the easiest two are these two right here. Okay, that's when you first learn deltas, those are the two that you tend to use the most. You know, let me just know how much this thing is going to go up or down in value for every dollar change in the underlying. And then the second one is, what's my probability of finishing in the money or out of the money? And so delta's a pretty good ratio for that. Those are the most common ways. Once you start getting a little bit more advanced options, you're going to start learning about hedge ratio, because delta is really good for helping you adjust positions. You need to understand what your delta of the entire position is to be able to do that. Okay. Now, it's the most watched and common Greek. I think just about everybody here, if you've been trading options, I think there are a couple of folks on here that are really new to options, but basically if you've been trading options, it is the most common Greek that you will encounter. Everybody knows about it. Okay. The other one is, in the money options have a higher delta. Why? Because remember what I said before. If you are the estimate of a likelihood of it expiring in the money, well, if an option is already in the money, then the probability of expiring in the money is higher, right? I mean, it goes without saying. And then by the same token, an out-of-the-money options have a lower delta, because if it's not in the money, then the probability of it moving to the money or in the money is lower than one that's already there. Again, you know, pretty basic stuff. And then finally, one that is at the money. When I say medium delta, generally you will see a delta of around 50. That's kind of a medium. But you can see that an at the money, truly at the money, where it's almost right at it, you know, it can vary from around 48, you know, all the way up to about 52, you know, maybe a little bit more depending on volatility and depending on how much time is left till expiration of that option, okay? And we'll go into how time affects this shortly. So let's look at definition number one, rate of change. It's the most basic, which is why I kind of put it as number one. As I said, it's the most common used. It defines the size of an option move per $1 move in the underlying. So let's go through an example, really simple to see. If a stock is at $60 a share, all right, and then it moves from $60 to $61 a share, and you've got a call that has a value of $3 right here, and then it moves up to 61. It moves up to $61 a share. This value increases to a $3.50. Why? Because you've got a delta of 50. So this thing, for $1 move, it says it's going to move up to 50. But one thing I do want you to pay, you know, pretty particular attention to is this transition right here. As we moved up $1, now look at delta. It's at 54. Now let's extend this out. I didn't do it on this graph, but let's say now the stock moves up to 62. Okay? If the stock moves up to 62, this option contract is going to be worth what? Well, it's going to be worth $4.04, right? Because now it's actually increased by 54 cents, that option contract. And then if I were to extend it up again, this delta may be worth 57. And then on and on and on we go. Why? Because we're moving deeper in the money. You go more in the money as this thing starts moving in your favor. So again, this is a long call. So what this tells you right away is it's the best of both worlds. As this thing starts making money, not only are you making money with each up move, but each up move you make a little bit more money, right? And then each up move after that, you make a little bit more money, even more. So now, as it moves up, you're increasing your money that you make. That is the picadillo of the long option with delta. You are long deltas. That is a good way to be, and it's probably the most easily understood for most option traders. Now, let's look at the other scenario. Stock goes in the other direction. You've got a delta of 50, again, just like up at the top, but now it goes down to 59. Stock goes, or the option contract, again, goes down 50 cents because you got a delta of 50. But now look at delta here. It's gone down to 46. Remember, you had a $1 move here, all right, and it went up to 54. You had a minus $1 move here, and it went down to 46. And then if I were to extend this out again, come out to 58 like this. Well, that doesn't look like a 58, does it? If it comes down to a 58 like this, well then delta then probably would come down to like a 42. And then I subtract 42 cents from that, and now the option contract is worth $2.08. So this is the best of both worlds if the stock is moving against you. If it's moving against you, you're losing money, but at a lesser rate. The more it moves against you, the less money per $1 move you lose. So if you think about it, guys, being long a contract here, long calls, long delta, it really works to your advantage, okay, with calls. It moves up, you make more money the higher it goes. It moves against you, you lose money, but every time it goes down lower and lower, you lose less money. That is being long the delta long calls. Now let's look at long puts. Again, we're going to stay with delta here. Now if I show this one here, and I'm just going to put them both on the screen at the same time, a long put, if we go from 60 to 61, that's negative, right? Because remember, with puts, what are you? You're bullish. If you're long puts, you're bullish. I'm bullish. You're bearish. You're bearish. So, so when a stock moves up, you're naturally going to lose value. Now, notice here the delta is a negative because you want to go down. You want it to go down, right? That's what you want with a put. So it goes down, but notice here, it moves against you. So here again, the delta decreases. So when the thing moves against you, and let's say we come down to 6, or we go up to 62. Remember, this is a put now. Well, then delta may come down to 33. All right. So now it's probably comes down here to 52 like this. So yeah, you're losing money, but you're losing less money as this stock moves away from your bias. Same thing right here. Notice here I've got a delta of minus 40, and then here it goes to minus 44 because it's moving down in my direction. So the takeaway, the key takeaway is when you are long an option contract, whether it's puts or calls, it does not matter. When you make money at an accelerating rate, meaning it's moving in your direction. And when you lose money, meaning if you're long a call and it moves down, or if you're long a put, it moves up. If you lose money at a decelerating rate. That's the best position to be in, okay? So that gives you the movement of delta and how these two are affected. Now let's add one other little thing to this. Let's talk about the derivative of the option price. This is what I talked about here that most people just kind of go, huh? And it really doesn't, you don't have to worry too much about it, but to be technically correct, I wanted to show it and include it on the chart here. Basically what this says, and let me choose a different color here so it'll stand out against that blue. If the price is right here, here's the stock price, here's the call price, right here, the dollar value. As the stock price goes up, all right, and it moves up, you've got a line. And I know you guys probably didn't remember this from algebra. There's a tangent line that there's only one type, because this is a curved line right here, all right? That blue line is technically curved, and it may be infinitesimally small, but every dot on that line can be touched one time by a straight line, all right? And that line defines the graph and the slope of delta at that point in time, which can also be used to define gamma. Gamma, which we will talk about in a second, measures the acceleration of delta. Okay, so that's all this is. You guys don't need to know too much about it until we get into the gamma side, but this is just it's a derivative of the option price. So derivative means it derives its price from the option price, essentially. Now, and this is just what I said. So the third one, this is going to be important when we get into part 2 on synthetics. It's kind of the underlying share equivalent. It's called the hedge ratio. In absolute terms, whether it's calls or puts, you take away the negative sign for puts, an option has a value between 0 and 1. Okay? So a call with a delta of 60, 0.60, means that $1 rise in the stock price causes the option price to go up 60 cents. Now understand, guys, when I say a stock goes from $30 to $31, you know, the way it works is it doesn't go from 30 to 31. You may have gaps and things like that, but generally go from 30 to $30.05, $30.10, $30.11, and it just kind of works its way up. So every little bite-sized chunk it starts moving up, delta moves infinitesimal until it starts making a bigger move when you can see the difference. But essentially, it's roughly about a $1 move by the time it goes up there with a delta of 50. So in this case right here, delta of 60 means that for every $1 move up, the option contract gains 60 cents. So how do you equate that to shares? Well, one contract equals 100 shares equals $60 or 60 shares. So when you've got a position on in a contract, you've got 10 contracts on, and you've got 10 contracts on Apple, and you go, well, shoot, that's the and I've got a 50 delta. That's like saying, well, that's 1,000 shares times 50% or 500 shares. So do I really mean to have a position that's the equivalent of 500 shares of Apple? Heck no. You know, I meant to really have the equivalent position of 100 shares. So this gives you an idea of being able to calculate an equivalent number. Why is that important? Well, if you want to hedge a position with a contra position, or you want to move things around a little bit, and again, we'll talk about it, you get into synthetics, you need to be able to very quickly know, well, what do I need to do as far as number of shares to zero out my position right away, all right, without closing down my option price, all right? So if you buy to open 5 contracts with a 43 delta, you have the equivalent of 215 deltas. That's 4 times 50, or 5 times 43, and then you multiply it by 100. And then that gives you the number of shares that you got are 215 shares. So if that's your position and you go, you know what, I want to hedge that, or I want to take a contra position in stock, and you are long calls, then you can short 215 shares of stock, and then mathematically you are flat. You don't own anything because you're going to equal one or the other for the time being until the stock continues to move, and then you don't become flat anymore. You probably heard the term delta neutral trading, or maybe gamma trading and scalping gamma. We've gone through those here in our session. I'll probably include those in some of these when we get into a little bit more of the advanced in part 2 or part 3 of the option Greeks. But that's what you've got to understand here for now, which is delta. Now, and then finally, the fourth definition. Remember I said the first definition, the price of the option contract going up per $1 move, that's probably the most common. The second most common is likelihood of expiring in the money. So it's not exactly mathematically precise, but an option delta projects the probability of an option finishing in the money. So an option with a delta of 60 has roughly a 60% probability of finishing in the money. Option with a delta of 34 has a 34%. So it's fairly simple, all right? So let's just a couple of recaps on the delta here. One, option deltas are not constant. They're based on the dynamic inputs of the model, stock price, time, and volatility. Stock price will affect delta naturally because if you're long a call or long a put, the more you go in the money, the higher the delta goes. The more you go away from the money, the lower the delta goes. The longer the time to expiration, then that will affect delta depending on the strike location. Volatility as well. And I'll give you an example of that in just 1 minute. Call and put pairs. What do I mean by a pair? Well, again, we'll go into that in detail in the synthetics, but essentially a put pair is on the same line of an option chain. So, and you guys know the option chain, right? So if you've got, 45, and then you got 50, and then you got 55 right here. So you've got an option chain, and then you're showing call prices over here. You're showing put prices over here. You got the bid, and you got the ask. You got the bid, and you got the ask right here. So you got the prices underneath each one of these lines right here. Well, a pair is defined as any pair here, right? That's a pair. So you go in and look at the 50 strike, both calls and puts. The 55 strike, both calls and puts. This right here is very key in deriving option price, and that is used into creating synthetics. Essentially, as a general rule, the absolute value when you add up a put and a call delta is you're going to come pretty much right up to 1. Okay, so you may have a call delta of 60 and a put delta of a -40 at a call pair, and you add them up and you come to 1. It will vary sometimes anywhere from 97 to 98 to 101 or 102, but that's due to just some correlation to if you're really deeply in the money. But otherwise, it's just called a put-call pair, and I'll show you how that goes into the synthetics when we cover that. This is the mathematical relationship because puts and calls have a very strong mathematical relationship to each other. I mean, they have to. They've got to balance themselves out. Otherwise, and that's where the risk arbitrage comes in, because anytime this price gets too far out of whack, and by too far, just by nickels and dimes, not by a lot, then you can have these, or even 10 or 15 cents sometimes, really. And they got arbitrage and big hedge funds, and all they do is they just go out there in their mathematical systems, look at all this stuff, calculate it, and they can buy one, sell the other, and then reverse it around and short the stock, and then they make their 2 or 3 cents. That's how they do it, and that forces the price back into balance again. So it's a pretty dynamic market that keeps all of this in balance. If it gets too far out of balance, one side sees it, tries to take advantage of it, and the fact that they're taking advantage of it puts it back into balance again. You and I, we don't even see it. We just take for granted that the price is a valid price. We take for granted when we see a call and we see a bid ask, that's the best bid and that's the best ask. That's what it is. And then this corresponding pair put, there's really no anomaly there. And that's pretty much the way it is. Options in the money, as I said, have a higher delta. Options at the money, approximately 50. Out of the money, have less than 50. Now, a couple of other things. What's the effect of time on delta? All right. If you think about it for a minute, if you've got very little time left in an option contract, let's take, I'm holding March expiry. I've only got till next Friday, and I'm deep in the money. All right. I'm deep in the money. Well, that's going to have a pretty high delta because I've got very little time left, and so the probability that finishing in the money is fairly high, hence a higher delta. But then let's say it's a leap option, and I'm in the money, but I've got 12 months left till that thing expires. Well, I'm not going to have as high of a delta, even though it's the same strike price, than if I had it right now expiring this week, because the odds of that finish in the money come down a little bit because I got 12 months to go. A lot of people don't realize this, but time affects delta. The more time left until an option expires, the less certain whether it's going to be in the money or out of the money. That's reflected in the delta that I just talked about. In the money options increase as expiration approaches. Well, that's what I just said. Think about it. You've got a stock at 50. You're holding a call that's at 45. So you're 5 points in the money. As option expiration is coming down, 5, 4, 3, 2, 1 days left, that delta, even if the stock doesn't move 1 penny, that delta just starts going up. I think a lot of you that are members that are following our Iron Condor trades probably see that very visually by looking at our short deltas and our short legs of the contracts. You can just see those things moving, bouncing around, and they get more sensitive as we get closer to expiration, and they get very sensitive to movement. Now, out of the money options decrease as expiration approaches. So just another example, if you're holding a short call, let's say it's a short call in a leg of an iron condor, and it's sitting at, I don't know, let's say 18, and then you've got 5 days left, and the price of the stock doesn't move much. It stays pretty much where it is, and all of a sudden now, instead of 5 days left, you got 3 days left till expiration. Well, that delta is going to go from 18 down to 12, maybe down to 11. It'll be cut by 30 or 40%, because now it's only got 3 days to get up into or out of the money. Or if you're deep in the money, then it'll be sitting the other way. It'll be sitting about 75 or 80. And then as you get closer, it'll go up to 90 or 95. So options change. Even though the underlying price does not change, I'm sorry, not options, the delta changes. So why is that significant? Well, if you're running, and once you start understanding the interaction of the Greeks, if you're running, let's say, an iron condor campaign, and I'm using that as an example because I think a lot of the members understand this, is you're playing with your short deltas. That's what you're playing with. And you're watching that short delta, and you know when it gets to a certain point you want to adjust it or you want to roll it, you know. And I think now you guys understand it a lot better than you did before. And you can just see that short delta bouncing around on the head of a razor blade. And then as you get closer to expiration, it gets very toppy. It gets very sensitive. And then all of a sudden, within about 3 days left, if you're way out of the money, you can breathe a sigh of relief because it goes down very quickly unless you get a black swan event and the stock moves like crazy, which can happen. So that's a little bit of an example of how time affects that. How about volatility? How do you think volatility would affect delta? Well, again, common sense always prevails. What does that mean? Well, as volatility increases, out of the money deltas increase, and in the money deltas decrease. Now think about that for just 1 second. What did I just say? If you've got a stock that moves in this price range right here, okay, and then all of a sudden volatility increases where now the price range of the stock movement is like that. And it doesn't always work like that. It can move up, it can move down, but basically the stock is moving at a wider range. And then you throw in a little bit of time out there. So let's say you're, I don't know, 35 days away from expiration. Volatility starts going up like that. Well, now if you're right out of the money a little bit, let's say you're at a 45 delta, but volatility goes up, guess what happens to that delta if you're out of the money? It increases. Now all of a sudden it may move up to 48. Why? Because the stock is moving bigger distances, which means you've got a higher probability here from 45 to 48 of finishing in the money. But by the same token, if you're in the money already and volatility starts kicking up, again, meaning the stock's going to move faster, now you've got a probability of it finishing out of the money. So if you're sitting in the money at, let's say, a 58, that stock starts getting really crazy and going up and down, a lot wider swings, your delta is probably going to go from 58 down to a 54. Why? Because now the probability of it finishing the money has diminished a little bit. So volatility and time affect delta. And some of you, your heads may be swimming a little bit and bouncing off walls, but I promise you, as you start following trades, you know, pretty much like for those of you that are members that follow our Iron Condor trades and our trade rationale for our primary exit, our secondary adjustment point, you start to follow this. You start to say, oh, yeah, now I'm starting to get this. You know, the brain comes on, the rat brain goes away, and you say, now I'm starting to understand why I may do it like this or do it like that, right? This is why, folks, there is no such thing, and I'm going to say this twice, there is no such thing as pure black and white rules. They do not exist. You can say, generally, I want to adjust this short strike if the delta goes down to X or Y, but you've got to understand that because volatility can affect delta, time can affect delta, and each one of them can make them more sensitive. And if they get more sensitive, you may say, well, knowing what I do know now, I know normally I would adjust here, but I'm going to adjust a little bit sooner because volatility is picking up. Or I've got more time and volatility is picking up, so it's really weighing me down. I think the analogy I used in our chat room today was that if you're driving a car and you're going through a stoplight at an intersection that you're comfortable with, you know the stoplight, so you know how long it sits on yellow before it goes to red, and you're driving along and you're pretty darn close and you're clipping along at 40 miles an hour, and the thing starts to turn to yellow, you go, well, I can beat this, it's pretty easy, I'm pretty close to it. You know, but if you back yourself up to where it's a little bit further away, same conditions, same yellow light, and you go, well, you know, I got this yellow light, but I'm going a little bit slower, and I don't think I'm going to make it, so I'm going to come to a stop pretty quickly. So I'm just going to take my foot off the accelerator and stop. Both of them showed a little yellow light. One of them, you were pretty darn close. You can make it all the way through. The other one, you're a little bit further back, and you're just not too sure of it, so you're going to slow down and stop. That's why there's too many variables to come up with a black and white guideline for any trade adjustment. What I try and do and what I try and tell our folks is generally when it gets to this, you want to adjust. But then as you start trading it and you get really good at it, you may do some adjustments before that. Like one of the things we did today with our iron condor is we did an early adjust just because of the way the markets were, you know, strong bullish, which is okay. We positioned it well, but that's just an example of using delta here and understanding the effects of volatility and time on your delta position. Now, as volatility decreases by the same token, then option deltas decrease out of the money, or in the money they increase. Why? Well, again, common sense prevails. If you're in the money and the movement of the stock slows down, then more than likely the odds are going to increase that you're going to stay in the money, or you're going to stay out of the money. Delta goes down, meaning the probability of finishing in the money is lower. So if you apply common sense to this, folks, it really makes it so much easier. And so that's just a little bit about delta. So we talked about the 4 attributes of delta: hedge ratio for every $1 move, change in option price, the probability of finishing in the money, and the derivative of the graph. And speaking of the derivative of the graph, let's get to the gamma, which basically measures the acceleration. Delta is I'm going 60 miles an hour. Gamma is I can do it in 4.6 seconds. All right. So that's like saying someone, yeah, I'm going to get this car and we're going to go 60 miles an hour. But it's an old beat-up Volkswagen Bug with 3 wheels and a flat tire. So it may take me about, 15 seconds to get there, but I'll get there. And the other guy's got a Porsche, and he goes, well, I'll get there in about 4.5 seconds. So gamma measures that acceleration of delta. This is pretty much what I just said, a rate of change of delta. It's stated in delta terms of deltas per dollar move. So you don't need to understand that. Just understand it measures acceleration, how fast delta how fast delta will increase. And that's the second derivative of the graph. Gamma, like delta, is not constant. Man, it'd be really easy if this stuff never changed, wouldn't it? You just put it on, you look at it, but that's not the case. It changes all the time. In the money and out of the options have lower gamma. Why? Because the delta, you're further away, and a small change is not going to be a big move in a change in delta. If you're around the 50, that's when you have the highest gamma. Why is that? Well, if you think about what is your delta when you're technically right at the money, your delta is 50. So a very small move in the money, your delta can go from 50 to 58 really quickly. If you just small move and boom, all of a sudden you're in the money. A small move to the downside and you're out of the money, and then let's say you're at 42, bam. So gamma is very high when you're right at the money, very high. So small movements will affect delta a lot, and that is measured by gamma. And, for those of you that understand some option strategies, and you got the P&L graph, and you have something that looks like this, which is a typical iron condor, which is probably the easiest one to show. Or you can do one like a butterfly that looks like that, You can see the gamma of this curve. Well, let's see here. Let me just come over here and pick this out right here. That's the gamma of the curve like that. It's the white line like that. All right, so when you're right at the money right there, a small move, it's very sensitive to movement in this gamma curve. And generally, this curve here is called a frown, right? So if you were to put a face on it like that, it would be a frown, right? It goes like that. That's a typical, that means it's you're guided by the short positions, which are right here or right here and right here. This would be a fly. This would be an iron condor. So generally, at the money has a higher gamma. Now, it really doesn't mean anything to you right now. You just hear it. But there are ways to use that when you start getting into synthetics and when you start getting into managing your positions or stress testing your positions. By the way, when you get into futures, really you don't play with gamma very much in futures options. You do look at delta, and you do look at volatility, and you do look at theta, but gamma really very rarely comes into play. Now, underlying price movement, long calls. Let's do the same analogy before, only this time we're going to use gamma. You can see right here, I put gamma on this line here, gamma of 4. So gamma means that when we move up 1, delta is going to move up by 4 points. And with another gamma of 4, that means we move up another 1. Delta is going to move up by 4. So what we're actually doing here is saying for every $1 move, delta is going to increase by 4 ticks. All right, delta is going to increase by 4 ticks. So that measures the acceleration of delta, both to the upside and to the downside. And then eventually, as you get away from, let's assume that's at the money, as you get away from it, gamma is going to start, it's going to start coming down to 0.3 and then to 0.2. It starts moving down. Same thing down here as well, okay? Same thing. Long puts, same way. Notice here, though, one thing I do want to point out, gamma is positive for both long puts and long calls. Delta is negative for long puts, but gamma is always positive. And that is why and I'm going to show you some P&L graphs here in a minute, but you'll see here gamma is always positive with a long position, whether you're long calls or long puts. When you are short a position, short a call or short a put, then you have negative gamma. Negative gamma is what gives you that frown. In other words, if that scenario right there, there's the P&L graph like that, right? It looks like that. Well, negative gamma gives you that frown like that in the P&L line for that, which is why here you're short a position here. This is a long put right here. Now, moving on, delta. When you buy long options, you acquire positive delta. We talked about that. Doesn't matter whether it's calls or puts, you got positive delta. I'm sorry, positive gamma. Positive gamma helps you. Causes options to gain value at a faster rate, lose value at a slower rate. That's what we talked about. When you sell or short an option, you acquire negative gamma. Negative gamma it really works against you as a short seller. It'll accelerate your losses. It's just the opposite. That's why when you've got an iron condor or something that's moving towards your short position, you've got to adjust that pretty quick. If you don't adjust it and get ahead of the curve, you're going to be adjusting late. And when you adjust late, it will cost you money. And sometimes that's probably what I see in a lot of my coaching one-on-one. That's probably one of the biggest areas of problems I see is people adjusting positions too late. And then once they do that, then it makes it very, very hard. If you stay ahead of the curve, then it really makes it a lot easier. Not that you're going to always win, but it puts the odds in your favor, okay? Now, theta. Theta is very important. It's very important whether you're a long, a single leg, or you're short, and you're a primary credit spread trader, or you're taking advantage of a premium decay. But option prices are broken down into the two components I told you, intrinsic and extrinsic. Intrinsic, as I said, is the easiest to measure because it's the in the money portion of an option. Okay? The extrinsic value is considered time value, and that premium is what you pay to buy that contract over the cost of the option. So if you got a stock that is, I don't know, let's say the stock is $50 a share, and you buy a strike a long strike of 45, you're long a call at 45, which means what? You've got the right, but not the obligation, but you got the right to buy that stock at 45. Well, you're $5 over already. So you're in the money by $5 right there. But when you buy that contract, you're not going to buy it for $5, right? It's probably going to cost you $5 plus some premium that you're going to pay. And that premium right there is going to be that extrinsic portion. And that's that portion that I told you about that is made up of the time value, which is affected by volatility, right, and time decay. So that's what you've got to understand here with theta. Now, and this is what we talked about, theta. Long options have negative theta. So if you buy a long call, like that example I just showed you, every day you're losing a little bit of value in that contract. So basically the way it's written is that if you have a theta of I don't know, let's call it 13 theta, that means you're going to lose 13 cents a day. It's based on a one-day move, okay? And I'll show you an option chain in a minute, so it'll be a little bit more sense for you. Short options is positive theta. These are credit spread traders. These are guys and gals that, you know, they want to come in there and they want to make money on this. The odds favor short option traders because you usually short and the stock can stay current. It can go up a little bit or it can go down a little bit and you can still make money. A long option player, not only does the stock have to, or the underlying security have to move enough to cover, it's got to move enough to cover your option premium, okay? So you've got to really be, you know, ready for that as just a long call player. Now, the other thing is interest rates are above zero, but right now they're not. They're about 25 basis points. Then call theta is higher than put theta. You don't really have to worry about that right now. If you buy a leap option and interest rates go up, then the value of a call will go up. Value of a put will go down. But generally, that's row, and we'll talk about it in a minute. But unless you're trading leaps all the time, it's one of those Greeks that most people don't pay a lot of attention to. At the money options have the highest theta. Why is that? Well, think about it. If you're at the money, right, here's the strike price right there. That's at the money. That's 50 right there. All right, and I'm sitting right there. That means all of my value that I pay for that, there is zero in the money. It's all out of the money, and I pay $4 for that. It's all sitting right here. That's all going to waste away to zero unless that stock moves up a minimum to $54 a share. If it moves up to $54 a share, then I didn't make any money. I just broke even. I've got to move up above $54 a share to make some money, okay? So the highest extrinsic value is at the money. That's where it's at right there. So if you're a credit spread trader, you need to understand, you know, where you place your strikes to determine how much premium decay you want to get. And there's positive and negatives with strike selection. You know, we'll get into that when we get into some of the strategies here in part 2 or part 3. Higher volatility also increases in options premiums, thus increasing theta decay. Well, think about it. I always call volatility the great white shark of option premium. Increasing volatility can double the cost of an option or cut it in half. This is the area where every individual trader who first gets into options will screw up. Everyone does. And I don't care how many books you read on it, you're going to screw it up. Why? Because you'd understand, you know, how volatility can take an option that should be priced at $3 and make it a $5 option. And then you think the stock is going to go up like that, so you buy it paying $5. The stock does, in fact, go up. In fact, it may go up even higher than you think. And then you look at your option, and it's only worth $4.50. And you're like, well, what the heck just happened there? My stock went up more than I thought, and I actually lost money on it. Volatility caused you to, you know, eat a little bit of dirt on that one. And volatility affects the premium of an option more so than anything else. So that's why having a little bit of a, or not a little bit, a good solid understanding of volatility is very, very important. Now, theta, it's not constant, it's non-linear. What do I mean by that? Well, the higher the extrinsic value, the higher the theta. Remember, theta is not applied to intrinsic value. It's extrinsic value only. And there is a time component to theta. And I think most of you probably already know this, that when you are in the last 15 days, theta moves the quickest. You can see right there, there's the option price right there, and it's almost half of that curve compared to the other half of the curve right here. At day 30, it really starts to move, but that's, this is only like maybe about 30% of the curve roughly. But the true movement happens in the last 2 weeks. And in the last week, it's about the same thing. It's almost half then again. So it decays at an accelerating rate as you approach option expiry. All right, remember that. That's why most credit spread traders and people that do short options usually stay within one option period. Although there are things to be said for going out more than 60 to 65 days. And, you'll see that in our iron, if you want to take our iron condor session, you can see that, or for you members out there, you can see sometimes we're going out more than 30 days makes sense, even though you're playing on theta decay. So this is a little bit about the time or days to expiry and how theta decay is accelerating. Let's talk about Vega for a second. This is probably the most important one as far as affecting the price of an option. Vega measures the rate of change of an option's theoretical value relative to the change in implied volatility. This is the value that when entered into an option pricing model returns the option's theoretical value. So what the hell did I just say? Well, what that really means is most market makers, when they plug in, they'll look at what the market's willing to bear for an option, and then they will plug in the remaining difference, and then that calculates what volatility is. So they kind of back into volatility with what the market's bearing, what the market will bear. That's why when you have a feeding frenzy and everybody's buying an option contract, that option contract starts going up in value. And immediately you're going to see volatility start going up in value. And that means the market knows something's going on there, so the price of that option contract is bid up. And it's bid up pretty quickly. And so option prices, they go up and down with the increase or decrease in volatility. Now, a call or a put with the same expiration month and the exact same strike on the same underline have the same volatility, the same Vega value. So remember when I told you about the call and put pairs for pricing? Well, for Vega, it's exactly the same. So if you've got a call with a volatility of 30, the put is going to have a volatility of 30. On a pair, same month, same strike, same underline. Long options have positive Vega, short options have negative Vega. Well, why is that important? Well, remember, with options, as you get really sophisticated with that, and you want to play a stock price that's going to go like that, well, guess what? You can play it two ways. You can play it with long options, or you can play it with short options by being short or being long. So now you got to say, well, I can use either long options and play a bullish play, or I can use short options and play a bullish play. Well, which one would be better to my advantage? Well, one of the things you're going to look at is the volatility of that particular underline. Every underline has its own volatility. You're going to look at implied volatility and historical volatility. Implied volatility is what the market is implying is going to happen to that option contract. It's implied. Historical volatility or statistical volatility is what has already happened in the past. It's a given number. So if historical volatility is at 30 and implied volatility is way up here at 45, and you look and see that this implied volatility hasn't, the normal volatility for this thing is around 30, then you know that volatility is very high. which means volatility is mean reverting, which means volatility will probably come back down. That means if volatility goes down, that's like saying, well, do I want to be long or short something that's falling? You want to be short. So now you say, well, remember, this stock is going up, but I know volatility is high, so volatility may come down because the stock is going up. So I want to do a bullish play, but I'm going to use short options to do it, which means then I'll be negative Vega. So as Vega falls down, that's going to actually help my position. That's part of the thinking process that you go through when you deploy options. Most people that get into options do not do that. They just see a stock, they go, I'm bullish, so let's go long calls. That's pretty much it. And by the way, let's go way out of the money because they're cheaper. And they end up losing everything. So this is a little bit about how this thing works. Now, another thing about volatility. The higher the time premium, the higher the Vega. All right, that pretty much is what we've been saying. If you've got more premium out there, volatility is going to be higher. Remember what I said with both Theta and Vega? If you've got something that's got an 85 delta, all right, that means you're really deep in the money. So that would be like saying I've got a stock at 50 and I got a strike price of, let's say, 40. And we don't have much time left. We got 2 weeks left till it expires. So I've got an 85 delta. Now that means the other part of my option value, let's say it's only got $1 of time decay left. Well, that right here of that $1, now I've got $10 of intrinsic value and I've got $1 of extrinsic value. Well, that $1 of extrinsic value is the only thing that's subject to Vega and Theta, not this $10. This $10 is what it is. It does not vary. Volatility can go up 5-fold. That stays the same. But this will go up or go down. So the resulting combined value will go up or go down. But this piece does not. Is not affected, which is why most option professionals will say if you want to negate a lot of volatility exposure or theta exposure, go deeper in the money. Now, you do know when you go deeper in the money, the cost of that option contract goes up, but you negate more of the Vega and Theta time decay. But there are advantages to doing that. Generally, what I tell most of my members is generally, if you're going to do a long leg, like a long put or a long call, start with a 70 delta, 70, 75 delta. That's the best place to start. Now, let's do an example. If an option is valued at $1.68, so it's $168 for one option contract, and Vega is 0.06, what does that mean? Well, that means that for every 1% change in volatility, 1%, right? 1% change in volatility, then my option contract is going to go up or down by 0.06 cents, depending on whether I'm long or short Vega. So if I go through this example, let's say volatility increases from 22 to 25%. Very common occurrence in an underlying security. Not a very big move, right? 22 to 25%. It can do that in one day. It can do that in one morning, real quick. The option value increases by 18 cents. Why? Well, that's a 3% increase. So 3 times 0.06, because that's what my Vega is, gives me 18 cents. So I add 18 cents to $1.68, and that gives me a new option price of $1.86. That's a 10.7% increase just because volatility just went up a little bit. Not much. So you can see what volatility can do. Now let's make it a little bit more. Let's say volatility goes up 17% or it falls 17% from 45 to 28. The option value decreases by, well, it went down 17% volatility. So you take 17 times my Vega of 0.06 and you get $1.02, and you subtract $1.02 from $1.68, you get 66 cents. So my option premium, my option price just decreased 60.7% just because of that change in volatility, assuming everything else is equal. All right. Now, when do you see this? Generally, you see this around earnings periods. Volatilities run up, and then all of a sudden, volatility falls off the table. Usually, stocks will move, but sometimes stocks won't move. But you're going to get crushed. It's called a vol crush because volatility drops. All the premium gets sucked right out of it, and then the option price decreases. In this case, almost 61% in value. So you can see here how volatility can really, really just make your day a bad one if you don't understand where you are with volatility with every security. That should be one of your checklists that you're looking at. Where does volatility normally trade? Okay. Now, volatility is based on kind of a random walk, or at least a little bit option pricing is based on a random walk. And what does that really mean? Generally, as this ball falls down, it's got a 50-50 chance where it falls that direction or this direction. Then it's got another 50% chance where it falls here, and so forth like that, right? And then you can just stair-step it down like this. And then another 50% chance and a 50% chance here. Okay, now I didn't hit this outside bar, but you get the idea. So you can see that if it always falls to the right like this, eventually you're going to have a couple of outliers out here like this and like that. Doesn't happen very often. You're going to get this random distribution like this. This is what these guys, Black-Scholes, came up with, and they won a Nobel Prize for. 68% of the time it's going to fall within a certain distribution. It's going to fall within that certain range. 95% of the time it's going to fall 2 standard deviations away. Every stock, every security has its own thumbprint. Every security has its own volatility. When you see IBM sitting here and they say, what's the vol of IBM? And they go, it's 25%. What does that mean? When someone says vol is 25% for IBM, that is based on an annualized basis. So when you see a quote of volatility, it's always based on an annualized amount. Now, that doesn't do you really much good if you want to trade IBM and you don't want to hold it for a year. You may only want to get in and out for one day. You may want to get in and out for 3 or 4 days. Well, never fear, because there is a way to de-annualize. There is a way to de-annualize volatility and come down to a one-day pattern, right, or a one-day. Now, you guys don't have to do this because every trading platform now will do this, but I can tell you 7 or 8 years ago, just about every one of them did not. Thinkorswim was one of the first to come out, and they developed it right around 2000, 2001, and they built a lot of this stuff in there. But before this, people had cheat sheets. They didn't do the calculations. They just had cheat sheets, and they had back of the napkin kind of things, and their guesstimates were fairly good. That's how they did it. But now everything is all done. But you can see here in the calculations where if I said, okay, I want to break it down, I take the square root of the number of calendar days divided by 365.25, multiply it by volatility, multiply it by price. So using 100 as a number, if you plug these things in, you'd see that a 1 standard deviation move in one day is roughly $1. 2 standard deviation move, $2. 3 standard deviation move, $3. And there's the range right there. And this gives you this whole concept here of standard deviation move. All option strategies, every strategy that you put on is based on probability of move, based on probability of movement. Why? Because option prices are priced that way. Options are priced not to make you money. They are priced to finish up pretty much even, dead even, assuming you buy something at the money. Now, what you've got to do is put a little bit of the finesse on your side. You've got to be able to understand, you know, how much time you got left till expiry, what's the volatility in the option, what's the strike price that you're going to pick it up at, and then you got to take a look at a chart and say, well, I think it's going to go in this direction right here. So you marry all these together and you come up with a strategy. All right. Once you start doing this, it does not. You get into a routine, which is probably the most important thing. You want to develop a routine for this. Now, if we look at row, which is the last one, It's the least important. It changes in relation to the interest rates. If interest rates go up, call value goes up. Well, we know that interest rates can't go any lower. So for those of you buying leaps, going out 1, 2, or even in some cases 3 years, you know, generally the interest rates are going to go up, so the call value is going to go up, but not by as much as you think. If interest rates go down, call value goes down. But in our case, the situation, the economic environment we're facing, more than likely interest rates are going to go up. Again, this is what I said. It's usually the least followed, mostly in leaps. Leaps are long-term equity appreciation rights, essentially, which basically just means any option contract that's more than 8 months, I believe, officially. But generally, you'll see leaps. Not all options have leaps, meaning you go out more than 8 months to a year. But most of them do. Most of the big ones do. So, for example, if something's got a row of 0.12, it'll increase 12 cents per option contract if interest rates rise a full 100 basis points. That's 1%. Well, I tell you, usually when the feds come out and they up rates, they do it normally quarter point at a time. So they'll do a 25 basis point. So that means instead of going up 12 cents, your contract will go up by 3 cents, right? So you just divide 0.12 by 3. So a 3-cent change. So it's not a lot. Now, where it comes into play are the big hedge funds that may have 1,000 option contracts, because there are ways using synthetics to isolate one Greek over and above everything else. So you can say, I don't care what happens to that option price. All I want is to trade volatility. I want to trade it down, or I want to trade an increase in interest rates. So there are ways to isolate that. We'll talk about that more in the synthetic side. But for now, most people don't worry about row. Now, the dividend effects on options, pretty basic. Dividends are paid. Paid dividends decrease call value and increase put value, right? But there are 4 key dates that you got to be aware of with the dividend. Now, it does affect options. That's why I'm including it here, even though it's not officially a Greek. I just wanted to put it in here just so that you guys are aware of this. Declaration date, that's when a company formally declares a dividend. Ex-dividend date, that's always 2 days before the record date, and that's due to stock settlement. So generally, it takes 2 days for a stock to settle. The record date is the date of record for who gets the dividend payment. And then finally is the payable date. That's the date of payment. So here's how it sounds. ABC Corp, basically ABC Corp on March 31st, that's the declaration date, so I'm declaring it. I formally declare it on March 31st, announces it will pay a 25-cent dividend to shareholders of record. That's the record date. Payable on April 23rd. That's the payable date. That means the market and excuse me, the market participants wishing to participate in this particular thing, they've got to own the stock on April 1st, which is when it goes ex-dividend. That is 2 days before the record date, right? Remember, ex-dividend date, 2 days before the record date. So most people aren't aware of this. They don't really follow it, and some of them don't even really care. I don't really trade dividends that much. It just doesn't really interest me. Most market makers are pretty smart about this. They already got a lot of this factored in, so there's not much of an edge, if any, that you're going to get. What you do need to understand about dividends is if you're holding short options, you can have your options, or if you've sold short options, meaning you're holding them, you're the writer of them, the guy or the woman that's holding those long, to them it's long options, they can say, I want them, give them to me, and you get a sign. So you got to be careful about that. But otherwise, this is the effect. Now, you do not have rights to dividends owning the option contracts. So as an example, a call value with a 10-cent dividend is, say, you plug this into a pricing model, and I did this. Use price at 61, 520 days out, long way to go. Call value is 965. You increase the dividend to 50 cents, the call value drops based on the pricing model. That's how it works. So the call value is actually reduced a pretty good bit by a dividend, especially if you're holding it pretty far away from expiry. By the same token, puts, they go up in value. So here's a 10-cent put, $5.42. If the put value goes up, or rather the dividend goes from 10 cents to 50 cents, then the put goes up. So the only thing I want you to know there is any call dividends, like, sometimes, and it happened a lot in a lot of our members. We saw it in Q4 of last year when we didn't know what was going to happen to the budget deficit, and a lot of companies didn't know what was going to happen to the taxes. So they were doing special dividends. I mean, left and right, every day or every other day, companies were coming out and announcing one-time special dividends to speed up dividend payments. Instead of doing them in January, they were doing them in December. So a lot of this affected some of the option pricing, and the fact that they were calls and they were going up, so it tended to reduce the value of the call option itself. Okay. Now, let's just kind of reiterate what we just talked about here. Greek effects on the underlying. A couple of things I want you to know. Well, if your stock, your delta is positive or negative, and your delta is what? It's always 1. A $1 move in stock is equal to a $1 move in the value of your profits or losses, right? Because you own a stock. It's simple. There is absolutely no Greeks affecting your stock. Now, if we take a look at long calls and long puts, you can see here with long calls and long puts right here, a couple things will stand out for you that I'll show you here. If we look at the long calls for the delta, one is positive, one is negative. However, notice here they're all exactly alike. Positive, negative, positive for gamma, theta, vega. So really, it's very simple to when you first get into it, you got to memorize it, but then eventually you'll pick it up pretty quick. If you're long a call or long a put, doesn't matter if you're long any option contract, your gamma, theta, vega are all the same. Positive gamma, negative theta, positive vega. Remember that your theta is always opposite of your gamma and your vega. So it's pretty simple. So you can just say, well, if I'm long a call or long a put, I've got negative theta, and then just assume positive for both the gamma and the vega. All right. And then the other side of the coin, it works the same way with the short side, right? On the short side of the equation, you've got right here, you've got negative delta for calls, positive delta for calls right here. But then when you break it down and you look at everything else, well, they're all the same. You've got negative, positive, negative, negative, positive, negative for gamma, theta, vega for shorts. So it works the same way, only it's just the opposite. Okay, so it's fairly simple to, at first you got to memorize it, but then once you start doing the positions, you can understand this. Now, in one of our next sessions of the Greeks, we're going to get into, well, when is gamma, or when is vega positive, when is it negative if we do a fly, right, versus an iron condor, versus a debit spread versus a credit spread versus a calendar versus a ratio spread. Every one of these has its own characteristics with Greeks. And we'll quickly just run through those in one of our other sessions after we cover synthetics. It's good to know this, folks. You have to know it. Not good. It's mandatory. Otherwise, I'll jump through this phone here and beat all you guys up. Now, so one other nice little thing here that just kind of summarizes everything. What are the Greek effects on the underlying? Well, it's real simple. Okay. But it's helpful. If your delta position is positive, you want the stock to go up. If your delta position is negative, you want it to fall. If your gamma position is positive, you want it to move really quickly. You don't really care which direction. If your gamma position is negative, you want it to move very slowly. So think of negative gamma as you're in a credit spread. You want that sucker to move very slow and let theta just waste away the premium. That's when you're making the money. If your theta is positive, passage of time will generally increase your value. If it's negative, it will decrease your value. Vega position is positive, you want volatility to rise. Remember what I said, positive Vega, well, if Vega is positive, that's like being long Vega. You want it to go up. Negative Vega, you want it to go down. You want volatility to fall. And rho, we don't really care much about, but if rho is positive, you want interest rates to rise. Rho is negative, you want them to fall. So now, when you start marrying different option positions together, you get a blended result of this, and as you get good at this, it really makes it pretty simple to figure out. Now, let's do a couple of things here, and we'll wrap this up. Option P&L graph, a long stock, you know, there's long stock. It's pretty simple, right? For every $1 $1 move this way, you know, it moves up $1 here, 1 for 1, like that. It's pretty simple. And what did we say about the Greeks? There are no Greeks here. The delta is 1. It's very simple for a long stock. Now, how about a long call? With a long call, what does that look like? Well, there's a long call. And what is a long call? Well, you've got rights. You don't have obligations with a long call. Your expectation is bullish. You can see here it's clearly a bullish play. It's a debit trade. You pay to play. What's the delta on a long call? Well, it's positive, right? Delta's positive. How about the gamma? What did we say for long positions? That's right. It's positive. How about theta? What did we say about theta? Well, theta is negative. How about Vega? Well, Vega's positive, right? Because we want, these are all the same, Vega and here. We're not going to cover rho on this one. So that is a long call. Now let's look at the next one. How about a short put? That's what a short put looks like. Now, a short put is also a bullish position. Obligation to buy. You've got an obligation. Why? Because you're short. Expectation is bullish, just like a long call. However, you're playing that bullish position as a credit trade. You get paid to play, right? So with a short put, how about delta? What do you think delta is? It's positive. You want it to go up. How about gamma? Gamma is negative, all right? How about theta? What is theta? Well, what do you think? It's positive. That's right. It's positive because theta helps you out in this position. And then how about Vega? Vega is negative. So if you guys remember, a long call is bullish, a short put is bullish, but this is completely different. The delta is the same, but these are all different. You've got a negative gamma, positive theta, negative Vega. With a long call, which is also bullish, you got a positive gamma, negative theta, positive Vega. So being able to come in here and say, what position do I, excuse me, what position do I want to hold with these guys right here? Do I want to be negative gamma, positive theta, negative Vega, or do I want to still play a bullish position but have a positive gamma, a negative theta, and a positive Vega? That comes with experience, folks. That comes with understanding the Greeks. That's why this is important. Most people don't know, and they just stay on the long side, and they end up not doing as well as they should. Now, let's look at the next one, a short stock. That's a short stock. Now, what about a short stock? You know, what's the delta? Well, it's -1, but it's just -1. That's all it is. Everything else is 0. There is no Greeks with a short stock. Pretty simple, right? Now, how about a short call? All right, what's a short call? Let's take a look at that. What is a short call? There it is right there. That shows you that you want to be bearish, right? You've got an obligation because you're short. Expectations bearish. It's a credit trade. You're going to get paid to play. Now, how about with a short call? With a short call, what is delta? What do you think delta is going to be? It's negative. Why? Because you want it to go down. You got a negative delta. How about gamma? What do you want gamma to be with a short call? Negative, right? Remember, anytime you're short anything, you got negative gamma. You got that gamma frown is what you got. Now, if gamma is negative, what is theta? Theta is positive. Theta is always opposite of gamma. It's an easy way to remember it. And if gamma is negative, what is Vega? Right. It's negative, right? That's the easy way to remember it. Theta is always opposite of gamma and Vega. So this is the position you want, and you're bearish. Now let's look at another one. Let's look at a long put. Here's another position. You're bearish, right? Expectation is bearish, but you have rights instead of obligations. This is the debit trade. But again, we're bearish. So let's take a look at the Greeks on this bearish trade. We are long a put. So what is our delta on this one? It's negative, right? Again, we want it to go down, just like the other one. But in this case, what's our gamma? Remember our other one, our gamma was negative. This one, it's positive. All right, if that means that's positive, what does that mean our theta is? It's right, negative. And if that's negative, what does that mean our Vega? Our Vega is positive. So here's another example where our gamma, theta, and Vega are completely opposite, yet we're both playing we're both playing a bearish trade here. We both want it to go down, but we are using our deltas to pick the best combination of deltas to match what the market is saying. Remember, in one we've got we're long Vega, and the other we're short Vega. So this becomes crucial when you start marrying up different positions. Okay, so that's a little bit about that one. One other quick thing here I'll throw in here for you. Pinning stocks. I know I saw this in one of our chat rooms. I thought I'd just add this in here. You have an option. Let's say you have expiration Friday coming up, and you got the following price in an ABC stock. I put this out here. I thought this would be good for you guys. You got a bid of $46.92 and ask of $46.94. So you got a very tight spread on this, 2 cents. There's a large open interest in the current month, 45 calls. That's what you are, you're 45. So if you've got a 45 call, this thing's getting ready to expire right away. So that means if you're a 45 call and you've got a bid of $46.92 or $46.94, at a minimum, you got $1.92 or $1.94, right? Just like that. And the strike price is 45 right there. So this is the intrinsic value you got in that option contract. Now, what are you going to do? That option contract's bid at $1.90, ask $1.95. That's what the market makers are going to do. Remember what I said. Your intrinsic here, $1.92 to $1.94. But you want to sell it. You don't want to get assigned the stock. Or you don't want to own that stock. So, but you can try and split the difference, but you're probably not going to get $1.94. So what most people do? What most people do is you'll sell the calls, but not. You'll probably sell them for $1.90 at the bid. Remember, that's the sell, that's the buy. So you're going to sell them to the market maker at $1.90. Now, what does the market maker do? Well, from his perspective, here's what they're going to immediately do. They're going to buy they're going to buy that 45 strike call for $1.90 right there. That's what you sold them to them for. They're going to immediately go out and exercise that call and buy 100 shares at $45 a share. Now remember, that's what this price is. And this guy is going to do this literally within 5 or 10 seconds. I mean, they do it so quick. They're so used to this, you don't even know it. So they'll buy it from you. They'll buy 100 shares of stock because they exercise that call. Then he turns around and sells 100 shares of ABC stock at $46.92, right? That's the selling right there. So if you look at it, he just exercised it for $1.90. He sells it for $46.92. He makes 2 cents profit on that. It's a guaranteed profit. Now, it doesn't sound like a lot, but that's 2 cents profit on every one that he does. And if he does that 5,000 times a day, that's $1,000 a day. And that's how market makers make their money. But when a market maker does this, look at one of the things that he's doing in order to affect this transaction. He's selling 100 shares of stock at $46.92. That's what he's doing, all right? He gets exercise. He buys 100 at 45. He sells at $46.92. And what that does is selling the stock on the open market like this, what he's doing is the larger the stock pulls back to 45, That's what he ends up driving the price down to. That's why you have pinning. Certain stocks pin more than others. Google is a really good one to pin. Apple tends to pin. You tend to look where you see a lot of volume in the open interest, and there are some traders that will play this pinning effect on option expiration day or the day before. It's a higher risk trade. I don't really do it, but I wanted to explain to you why stocks pin. It's just strictly the mechanisms of how market makers hedge their bet, because you can't sell it at the ask and buy at the bid. You got to sell at the bid, buy at the ask. Okay. Now, a couple of other quick things I did this morning, but I'm going to include them here. Intermarket relationships, U.S. dollar. Generally, when the dollar goes down, commodities go up. There's a really strong link between the dollar, interest rates, and the equity markets. So you can see right here as the U.S. dollar goes up, the CRB, which is kind of a commodity index, it kind of goes down. The other thing here is the textbook example of relationships is this. A falling dollar equals rising commodity prices. You can see right here the S&P's in red, commodities is in blue, the U.S. dollar's in green, 30-year bond prices in pink. But a falling U.S. dollar equals rising commodity prices. Generally, rising commodity prices adds inflation. Inflation then makes interest rates higher. Higher interest rates adds to lower bond prices. Lower bond prices generally drive stocks lower. So that's kind of a cycle that we go through. We're seeing a lot of intermarket analysis now. I think we spent a lot of time this morning in our pre-market session on intermarket. We also spent some time on Tuesday to look for sector rotation and how this works. So I just wanted to do a really quick run through for a lot of you that are non-members just to kind of show you what are some of the things that we're covering here. And these are really good tells as to how you trade these stocks. Now, this last thing here, if you don't have a copy of it, send me a note, send me an email, and I'll get it out to you. But this is our trade strategy checklist here. Every trade that you do with options, you want to come through, select your security. What's your bias? Neutral, mildly bullish, mildly bearish, strongly bearish, unknown, meaning you want to play a breakout. You don't know which way it's going to go, but you're going to play a breakout. So it's more like a volatility trade. What's the magnitude of the forecasted move? How big is it going to move? That helps you with strike selection. What's the time frame of the forecasted movement? That helps you with the expiration period. Is there a trigger price for the move? Does it have to move up and through or below a key S1 or R1 line? Those are support or resistance lines. What's the support and resistance for the security? That kind of goes into trigger price. How will I know if my original bias is wrong during the trade? Well, that's really important because this goes into trade adjustments. And what is the current implied volatility and what is the current historical volatility of that thing that I'm trading? You got to know that, guys. That's something that a lot of people generally overlook, but it's one of the more important ones. If you're using options, you better make this. I mean, this has got to be, this one is, in my mind, that is a key thing that you've got to know there. So that's another one. And then, of course, what's your current risk appetite? What's your position size for the trade? And like I said before, what's your primary exit point? What's your secondary exit point? If your original bias is wrong, do you adjust or do you just get out of the trade? That's defining your secondary exit point. What are your stops? When do you take profits? How do you take profits? And then finally, what are your objectives for this trade? Is it just for income, high probability, low return, like I want an 80% probability of success, but just a 10 to 15% return? Or am I looking to hedge? So I'm not looking to make a profit, I just want to hedge other positions. Or am I looking for a bigger capital gain, or I'm not a capital gain, but a big revenue gain of 20% plus. So that is a strategy selection checklist. You guys should have that and understand it every time you go through a trade. All right, everybody, I'm going to turn the recording off.